Flexing ain't discreet about it. Extra read about it. Say you wanna beef about it. We gon' come and see about it. Flexing ain't discreet about it.
What is up, everybody?
What's going on?
So this is Outliers, we'll say 7.
Yeah, something like that.
I'm swagged out in Outlier gear.
Yep, I'm representing with the pen, so.
And that's something that we were just talking about, of like more merch and stuff. But
which is coming.
Yep, it's going to be awesome. But yeah, so today wanted to talk about mortgage rates again. I know we've done this before, but things have been developing as they always are, and things are weird. I've been talking to clients and other agents, brokers, and we're all just trying to make sense of the market right now. And it's kind of been this way for a couple months, it seems like. It's just weird. Things are sitting that shouldn't be sitting, assumingly, and then things are going over asking that it's weird. But with all that said, the Fed came out on Wednesday of last week. So today is Tuesday the 6th. They came out on, what was that, the 31st?
31st, yep.
And my birthday. And made an announcement that kind of ruffled people's feathers a little bit and kind of set the expectation in terms of the spring market. So let's get into it.
Do you want me to pull up this first one?
Yeah, go ahead. So what we're going to look at now, this is from Fox Business. So again, today's February 6th. Just wanted to bring up the current mortgage rates today to show that. So scroll up a little bit, I think. Okay, here we go. The interest rate on 30-year fixed rate mortgage is 6.25 as of today, which is 0.25 percentage points lower than yesterday. Additionally, the interest rate on 15-year is 5.75. So a lot better than what we have been saying. I've mentioned it before, and I'll say it again. The height of these interest rates were back around Halloween of 23. We were right about 8%. So, I mean, we're almost a full 2 percentage points less than that now. So,
in about 5 months.
Yep. And there hasn't been any movement from the Fed in that. It's just that things are more or less stabilized, and people are under the assumption, based on what the Fed has told us, that rates will drop. And so that's where we're able to see, because yes, this is tied to the 10-year yield treasury bond, but it's also, it's kind of complicated. It's tied to that, but it's not only that. It's also in terms of the market itself and investors and where they see the market going. How does this look in the next few months type of thing? That also plays into a factor on this. So right then and there, I mean, the buying power has drastically increased from, let's say, October of 23 to now. What has not drastically increased or decreased is these home prices. If anything, they're kind of going up again. And this just simply goes back to supply and demand. It's really as simple as economics get in business. Is like, okay, I have something people want. There's not enough of it, so the people that want are willing to pay more than what I would originally sell it for.
Yep. And then with economic factors such as rate drops, you get more buyers in the market, which makes a higher demand, which is going to increase your prices, right? Because the supply is really staying the same. The supply isn't really going up. We talked about new builds, obviously, how you can't build them fast enough. Again, basic economics right there.
And just to delve into that a little bit, you're right. Put simply, the only thing that really hasn't changed is the supply. Demand's still there, if not more so now, and soon to be even more then, because we're only in February right now. And it's Michigan. People typically don't like moving, buying, selling in the winter because snow sucks. But we're about to hit the spring market, and I was looking today based on last year's numbers. Guess what month had the most sales in Michigan?
March? May?
June. which again makes sense. We've talked about this. It's very rare for somebody to say, okay, let's go house hunting and write an offer on the first few properties they see and get accepted right away. It doesn't happen. It takes time. So if you start in March, 90 days, 45 days to close, you get to June.
Yeah. In an ideal world, people are starting in January and in February starting to look that way. In March, April, May, they're starting to get closing, because that's what kind of a lot of things we'll get into today as well. But that's kind of what we're recommending to a lot of people. And there's a lot of reasons for that.
Yeah. For you guys who've been listening to us and what we've been spouting off, not to say I've changed necessarily, but I guess my mentality's shifted a little bit in terms of seeing what's happening, how this plays out in, going forward this year. And on top of that, if not this year, what happens next year? And that's another big piece of this. So if you don't mind, pull up the next one. So we already established today's rates. And keep in mind, that's with having great credit. I think a better average is probably about 6.5. But, either way. So tying this back into the Fed and Mr. Jerome Powell, he's the Fed chair. He was appointed by Barack, and then he was made chair by Donald Trump, and then Biden retained him as chair when he came into the office. The whole, put simply, the whole point of the Fed chair is to regulate our economy and make sure inflation doesn't get out of whack, CPI, and then on top of that, they also regulate banks and all that fun stuff. But Jerome Powell has a lot of power, and people do not really think of that in terms of it's the president and the Senate and, you name the players, but he has a lot of pull. I mean, he's the one that's pulling the levers of the economy, more or less. So with all that said, he came out on the 31st of January with their standard meeting of the announcement of what are we going to do come March, which is typically when they either drop, don't do anything, or raise interest rates. He came out and said that we're not going to do jack come March. Reason for that is they have a goal for the inflation rate to go to 2%. Right now we're at 3.2 or something.
Quote unquote. That's what they're saying, so we'll go with that, I guess.
But in his mind, and we'll read this article, so CBS 60 Minutes in particular sat down with him. It was actually a good interview. If you guys want to check it out, it's only 14 minutes. But they kind of go in depth about this stuff, and we're just pulling the transcript up to save time. But so Scott Pelley of 60 Minutes said, "You disappointed a lot of people on Wednesday because you did not lower rates," which is a little background for you guys. The rumor mill has been that we'll see 3 to 4 rate decreases this year. Well, if you're not doing it in March, that eliminates one of those. So now we're back to 3 to 2 rate drops this year. So you disappointed a lot of people on Wednesday, said Scott Pelley. Jerome Powell, "I can't overstate how important it is to restore price stability, by which I mean inflation is low and predictable and people don't have to think about it in their daily lives. That's where we were for 20 years. We want to get back to that." And he's a controversial figure. And I mean, I'll just be honest. I haven't done a whole lot of research into past Fed chairs and, grading them. But from what I can tell, Jerome has done a pretty damn good job. I wouldn't give him an A, but B plus.
Let's say that's what I would give him. Back in my earlier investor days, throughout the late 2010s, I got really into this because it had a big factor into currencies, things like that. And he's better, more good than not, right? So I would say probably a B plus. I'd be with you right
and
there.
He was kind of given a crap sandwich, more or less, of okay, well, we've had 2-3 years, and he was part of that, mind you, because he was the chair then, of historically low interest rates, which were absurdly low. And I've said that plenty of times, and I will keep spouting that off because that's a big problem as to why we're where we are now. But despite all that, despite all the COVID issues, everything that happened, lo and behold, the U.S. has come out pretty clean. Like they kept saying the soft landing, and it seems like we kind of got that.
Yeah, I think I think the stimulus money is what made everything 10 times worse. And also Donald Trump, DT, he was a big part of that as well. Not a lot of people like to talk about it. He was a big part of that. I mean, how much money did we print in 2020? Way too much money, right? Way too much. So Jerome Powell isn't really he's kind of in that camp, but like not really. I think we'd be a lot better off if we didn't obviously print all that stimulus money. But to your point, I'm surprised we are as okay as we are. I was expecting 08, 09 level things, but maybe not specifically just in the housing industry. I think just across the economy in general. 08, 09 was the catalyst was the housing industry. I thought it was going to be different catalyst this time. But it seems like we're relatively okay. Obviously, inflation's been extremely high, and people have been feeling that. I mean, you look all over social media, and people are not happy, and you see all just the political polling side of things as well. People are pissed.
Well, and like if you look at the actual numbers of like the developed countries, okay, and what they did with COVID and economically after that, U.S. is by far the one that came out the cleanest, which is pretty amazing. And then to your point, which if you watch the whole interview, they talk about that of like, your bread, eggs, just general grocery stuff. That stuff has gone up, and he talks about that. And he's like, they get into depth about, okay, so once we get to the 2%, what does that mean for the general public? And he says, he's like, look, some things are going to stay pretty much the same, but some things will go up in price. It just kind of is what it is. But yeah, you bring a good point in that this gets said a lot, and they're not wrong. The stock market's been doing very well, but that does not mean it translates to Main Street and like you and me and other, people just doing their daily lives. It's like, okay, well, cool, you're making, cool, the S&P reached $40,000 in valuation or whatever, but like, I don't care, 40,000 points, whatever.
Yeah. And I guess what I'm curious about, and we'll get to this here in a minute more, so I guess my one of my questions is like, what happens this presidential election year, right? And so that's kind of where one thing, and there's some data will show up here in a minute, right? That kind of would be a frontline defense for, I guess, what my question's about to be. I think it might go differently. Basically, we'll show the data, but essentially what it is like, even in a presidential election, it generally remains unchanged, relatively, right? It may go up or down a tiny percentage points, but nothing significant. But what I am thinking or theorizing, if Donald Trump wins, right, his big thing is the economy, and he did have an amazing economy, but also there's a lot of artificially low interest rates. That's, aside from, I won't get into politics on this podcast, but that's number 2 top issue right now for voters is the economy, right, is inflation. So I'm theorizing maybe he comes in and just says, nope, we're cutting everything. We're dropping rates. We're doing all this or that just to drop everything low. And it's like, okay, does that totally change the course of everything that's kind of set planned for right now?
And that's exactly it. To that point, where Jerome I think he can like stick his flag in the ground, is he did the tough thing of, hey, we're going to make historical rate rises to these interest rates that you've never seen before. They did 11, and that has never happened before. And there's even a clip I was watching today of Elizabeth Warren basically begging and pleading Jerome to stop doing these rate rises because it was affecting the economy and everything else. And he stuck to his guns, thankfully. I mean, what if he didn't do this? We'd be having a completely different conversation right now. What we're talking about is it's about to pop off and just cut to the chase. So we're at, 6.2, 6.5-ish interest rate. Can you pull up this next article? Yep. And then we'll get to the point about the president, because that is important too. But what we need to show, shout out Rocket Mortgage. Don't use them. But this is a great article. So they go into interest rate hikes. I keep saying that wrong. Hikes since 2022 and kind of what the federal fund rate was, blah, blah, blah. That's all well and good. What I wanted to look at is the decades. So go down a little bit and it goes, and they do a really cool job of like, okay, 1970s, your average mortgage rate fluctuated between 7.5% and 9%. Okay. We're below that now already. 1980s, that was a disaster of a decade, which was 13.5% in 1980. Before you millennials and Gen Zers yell at me, I get it. These houses were 25 grand. I get that. But we got to set a precedent here. So 13.5 in 1980, blah, 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 blah. At this time, the annual mortgage rate was 16.63%. That was the average, which is the highest in history. Okay. Yeah, that's insane. That's like a credit card. 1990s saw a decrease in both inflation and interest rates. Say what you will about Bill Clinton and what happened with Monica, but he was good on the economy. The decade saw economic boom, blah, 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 blah. Part of the internet was part of that for sure. By the end of the decade, mortgage rates were just under 7. Okay, so we're still lower than that right now. We're right about under 7, right? Then the 2000s come in. 2000, let's see, we all know about 07, 08. That was a disaster, blah, 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 blah. The Fed slashed interest rates to near zero. As a result of the average mortgage rates fell to just above 5%. So that was 2000s. Then we get to 2010s. 2010s, that was another dark time in real estate. It really didn't pop off again until like 2014, 15. So 4.69 and 3.65 respectively. By 2019, the average was 3.94. Inflation was just under 2%.
Which is insanely low.
So now we're seeing where we're getting close to that crazy, numbers in 2019, 2020. So then 2020's hit, and then we all know what happened. Mortgage rates were, I had one client at one point get like a 2.2. Like it was ludicrous. But like the average was just under 3. Yeah. I mean, and then COVID hit and we all know what happened after that. But you see the trends here of like, okay, 70s were right around 7%. 80s were an anomaly. That was a disaster in terms of economics. If we go back to 16, nobody's going to buy a house. But then the 90s come down and then again, just under 7. 2000s just under 5, and then in 2010s things change, and then 20s COVID hit and everything, and then went back up again. But with all that said, your average is like 6-ish%, which is where we're at now. And God forbid we ever go back to that sub 3%, frankly even sub 4, sub 5. I think we're kind of right now hitting equilibrium, and you're seeing that. I'm seeing that in my day-to-day work life of like some of these sellers aren't getting what they're asking, and some of these buyers are able to kind of negotiate for concessions. I just had one of those myself. Granted, they had to pay over asking to get it, but then they're able to get concessions back. So it's more of a balanced playing field, I guess is what I'm getting at. The one point that sellers still have a tip is that the supply is not there. So if you have a house to sell, you're one of 10 in some areas.
What's interesting that I think has never really happened before, ever, maybe in the early 2010s, but due to the massive negative impact that 08, 09 had, there wasn't as many buyers, I'm assuming, in that market at the time. But what I'm getting at is you have these sellers who back in 2021 got a 2.5% interest rate. Why would I sell? You have to go incredibly over asking for it to be worth it for me, given the interest rates now, right? Or they make it into a rental and buy another. There's kind of that. So there's never really been a time in history before where it's from the seller side, there's this argument of like, why should I sell? So it's going to decrease the supply even more.
That is a massive, massive point, because you're absolutely right. You know people that I've been talking to recently, and they're like, hey, like I one guy in particular, not gonna name him, but he called me. He's like, hey, like where are the interest rates right now? Like I'm kind of contemplating buying a house again, blah blah blah. I tell him, and I do a quick estimate of what his payment's gonna be, and he's like, hell no. He's like, at that point, I'm just going to start stacking cash, turn mine into a rental because I'm at 2.4% interest, and I'll just buy it. And with all that said, yes, you're absolutely right. There is very little incentive for people that do not have to sell. And that is just perpetuating this inventory issue. On top of the new build thing, you can check out last week's episode for that. But yeah, that is something that I don't know. Like, I have a rental that has not 2.5% because that's near impossible to get for a rental property, but it's low. And it's like, why would we ever sell that?
5 years down the line from now, 7 years down the line from now, it's like you're going to be having all these people who in the normal grand scheme of the real estate market over their lifetime, they would probably have bought and sold 2 more houses by this point. But they're like, I got 2.5% interest. Why would I ever sell this thing? And it's that question of, is it worth it for me to sell this and buy something else? Or should I just keep this as a rental, buy another one whenever the next kind of drop of interest rates go and keep that one? So it's going to decrease supply even more and even more. 9 years from now, what does that look like for the economy?
So exactly. And now I'm going to throw this at you now. Because, so now we're at 6.25, taking it back to like currently, okay? 6.25, 6.5. Let's say, so the next time the Fed meets is going to be May, okay? Assuming they are going to drop, because he already said they're probably not doing it in March. So let's say it's May. If they drop it by, let's say, 1/4 percentage point, so 0.25, it's not an exact correlation. It doesn't mean that the rates are going to be 6% now because, but let's say they do it again. My question to you is, what happens when we get sub 6%?
Oh, you're going to get so many buyers in the market, and then home values are going to keep going up and up and up and up, and you're going to have to get all these above asking offers again.
It's going to get nuts. Mm-hmm. It's already happening now. I just had a client that paid $10,000 over asking with a guarantee, and we got it. Luckily, the house actually appraised, so they saved that $10,000. But that was January, and now we're in February 6th. But this is already happening. You're seeing it in these quote unquote lower price points of your first time home buyer range of like to 250. That's where you're seeing these over asking things. Once above that, once you get to the 300-400, it's just a different type of buyer and not as much competition right now because of the interest rates going, so on and so forth. But you're absolutely right, and this is where I'm going to kind of deviate from what we've been talking about recently, is that, so we're in an election year. We're already hovering about 6%. We're expecting more rate drops to happen, which assumingly will be, if not close to under 6% by the end of this year, being 2023. Now that we've had a full year and then some of people being used to these 7, almost 8% rates, sub 6% looks like a steal, right? Obviously, there are those people that you brought up that are 2.5% to 3% that still may not be incentivized to sell those homes, but that only adds fuel to the fire of these prices, like you said, because there's still a lack of supply, and there's a lot of these buyers who've been waiting on the sidelines for the last 2 years because of these interest rates. And now, I don't know. My fear is that I don't have my crystal ball. Let me preface that, right? My fear is, regardless of who wins this presidential election, it could be DT, it could be JB, doesn't matter. My fear is that you brought up the economy as a big pain point for voters right now in the general pop. Whoever wins, they are going to be incentivized based on ratings and, approval ratings and everything to drop these interest rates. In which case, if we get back to 5, all bets are off. Is like you would have, if you don't buy this year and you're in the market to buy, if you don't buy this year hoping to do it next year when the rates are lower, you're going to overspend on this house. I'll tell you right now, because it's going to go over asking. These appraisal guarantees are coming in. You're competing with people who've been sitting on the sidelines for 4 or 5 years stacking cash. And you would wish you took the higher interest rate and then refied when they dropped again.
Mm-hmm. I think there's a meeting of two camps at the moment. For all of this year, there's going to be a meeting of two camps. It's the people who have been waiting 2-3 years to buy and saving up a bunch of money that are in that sub $300,000 range, and the people who under really low interest rates would have been in the $300,000 to $400,000 range. They're now meeting in the middle, coming into sub 300. And guess where that supply is? That's the lowest supply in the entire market anyway, right? Realistically. And now that's going to be the hottest commodity around. That's going to even increase the competition even more so.
What a damn good point. I didn't even think about. You're absolutely right. Because you have these people that, when it was sub 3%, your average Joe Blow making $50,000 a year could buy a $250,000 house affordably. But now it's priced people out. So those people, like you said, they were buying those $300,000-$400,000 houses. Like, okay, well, I got to drop this to $250,000 now because of these rates. And now we're getting a big conglomerate of all these buyers sandwiched in these price points. Massive point.
Mm-hmm. So what does that mean for our, the average buyer out there looking to buy?
So what this means is, especially right now before the rates really do drop, right now, if you can afford where we're at let's say 6.5, if you can afford to do it, you might be better off buying sooner than later, like AKA during now and into spring, because come May, these rates are dropping, and then they meet again in June. It may happen again in June. And it's like, okay, well, now it's like we're probably hovering under 6%, and it is going to get nuts. It's on top of time of the year, summer is already naturally busy. And then again, tying into the upcoming presidential election, I just don't see why they wouldn't lower rates even further just to benefit them and the appeal,
Yeah, if you guys can get in 2-3 months in front of everybody else, and if you can afford it, assuming that you can afford it at 6.5%, and your salary now, all this type of stuff, as soon as you can afford it now, or the payment that it's going to be, get in 2 or 3 months before everybody else.
Exactly. To your point, don't buy under the assumption they'll drop. Okay, just preface that, because again, I don't have my crystal ball. They probably will drop, but again, in terms of affordability, setting yourself up for success, make sure you can afford it at the current interest rates when you get approved. But if you can swing it, and I'm sure more people are going to be talking about this, I've already seen it. I hate this whole, fear mongering. Perfect. Thank you. That happens, but I'm just talking for clients and future clients. They're not wrong. If you can swing it right now, you're gonna save on that, let's say, the purchase power, than you will 6-12 months from now.
Mm-hmm. I think there's some validity in that for sure. I think, again, you don't buy under the assumption that rates are gonna drop over the long term. They will drop. It's just economics. Over the next 5-7 years, it will drop. And again, going back to make sure you can afford it. If you can afford it, try and get in before everybody else. When that time comes, whoever knows when it is, rates drop, you can refi. There you go.
Don't wait for rates to come below 3, because it's never going to happen again. If they do, we're going to have bigger issues than what we're talking about now. So, with all that said, we're starting to hit the realm of like where the averages are, and hopefully will stay. So pull the trigger now before the word gets out and everybody starts jumping in.
Yep. Thanks for listening. Bye-bye.